Good morning, good morning, good morning. Welcome to the Morning Blast. It is Tuesday, the 21st of April, all day. This is your most candid and upfront and honest market-related podcast there is, with myself, Ryan, and of course, Michael. Nothing we say on the podcast is trading or investment advice. The podcast recordings are listed as explicit because we don't bother putting any editing into them, and we do swear like sailors. Michael, how are you?
Indeed we do. Very good morning to you, Ryan. Good morning, everyone. Not too bad, although I am feeling just a little bit ranty this morning.
Oh, good.
After some news that we had out of the UK earlier on.
Oh, no, apparently everything's going swimmingly with the UK. It's perfect. Forget the fact that it seems to be the only sector that's growing is the public sector. But yeah, we can skirt over.
Well, according to some fella on who came across my Twitter feed this morning, I quote, I quote, our impressive Chancellor is turning our economy around and definitely growing it.
This wouldn't be Tris Osborne MP, would it?
No, it wouldn't. I'm still utterly shocked that fella hasn't blocked me after he said last week interest rates are falling, to which I replied with a chart of the 10-year gilt yield and went, can you point out the bit where it's falling, please? And he then decided to go on a rant about right-wing wars. So there we are.
I've noticed that's his kind of default get-out whenever he...
It is, isn't it?
Gets a bit stumped. He always seems to blame Farage's war in the Middle East. I'm like, well, not even funny, mate, but Farage has got no power whatsoever. So, yeah, whatever makes him happy.
He is one of many utter spanners that there are on the Labour benches at the moment.
Speaking of spanners, should we get the futures text live? Clive Lambert's.
Good morning, Clive.
Morning, Clive. Obviously, Clive's pulling what remains of his hair out at the moment because the rule of 9 that he
I thought you were going to say he's pulling like a train, but...
Well, he's already pulled like a train,
yeah.
But yeah, his rule of 9 is completely gone out the window. So anyways, let's get a market update and levels to watch today from our dear friend Clive Lamberts from Futures Techs. S&P saw green again yesterday. That's 11 in a row for the futures. Clive believes it's getting silly. I believe it's just getting started. Obviously, I am long. Yesterday's gains were seen after a weaker open. A pretty well-worn script for a Monday these days. Gap lower, grind up through the day. Nasdaq futures also posted a green candle. Again, that's the 11th in the row for the futures markets. I believe I think the cash might have gone on a little bit longer than this already now. European indices followed suit, mostly putting in doji candles, so all wick, no body. Bund futures held Marabouzi support at 125.62, but still shy of the 126.26 level, which is the Fibonacci that's been in play for quite a while now. Euro dollar and cable both gapped lower yesterday morning, but both recovered. Similar theme there. So might have another look at the Fibonacci levels where sellers returned last week, and they are 118.27 and 136.00 respectively. Gold and silver saw dip buying yesterday, but both were offered overnight, so looking to see if a similar response will be seen there. Pretty uninspiring around the rest of the metals world yesterday. Lots of doji candles out there, which basically means they move around, but they close roughly where they started. Even oil markets were pretty quiet yesterday as we wait for the next big bit of news. It's nice to see Clive mentioning news in a technical roundup. Brent crude is still north of the 91.66 level that we've been kind of talking about for a little while now. TTF, European gas benchmark, followed the now familiar Monday script of opening higher and then selling off. Obviously the inverse of the equities. 38.15, 33.43 and 32.26 are supports to watch and target on further weakness to the downside. EU carbon markets caught a bid on Friday up to 78.06 to put some distance on the 74.74 level that we've been watching of late. Yesterday saw weakness, but 74.74 still isn't worried, so we stick with the bulls for now until that level is crossed. So yeah, as Clive said, a bit dull as it goes, but which is a bit refreshing. It seems like everyone is sitting in that wait and see moment, trying to get some more headlines. I think what we've now heard we've heard from one source that the Iranians are going to Pakistan. We've heard from another source that they're not. So yeah, what are your thoughts?
Well, exactly. I mean, I think that framing is probably spot on. It does increasingly feel like market participants are kind of getting headline fatigue once more, simply because there is just so much news flow. And to be completely honest with you, most of it is noise as opposed to providing any sort of signal at this stage. It does appear if you look at the sort of totality of those headlines, that these US-Iran talks will take place in Pakistan tomorrow. Again, it's somewhat up in the air as to who from the Iranian side is attending. But again, as we said on podcast yesterday, I would stress that we had exactly this in the run-up to the first round of negotiations, and then they all rocked up anyway. So I think a lot of this is kind of posturing once more. We did also hear on the Middle East from President Trump yesterday. He was talking to Bloomberg. He said that the US-Iran ceasefire will expire Wednesday evening Eastern time. The reason why I mentioned this is because there have been quite a lot of confusion and consternation as to exactly when this ceasefire was due to expire. Trump saying tomorrow night on the east coast of the States, so kind of overnight for those of us here in London. He also said that he is highly unlikely to extend the ceasefire. Again, that's not a no. Again, that's what he said previously. And again, I think speaking to the majority of market participants I've spoken to over the last day or so, everyone is very much working on the assumption that if there's not a deal, then we will probably see the can kick down the road in terms of the ceasefire.
It must be highlighted well that when he said, well, at least one time when he said he doesn't expect it to be extended, it's because he was expecting a deal, not for it to deteriorate. So let's be very clear. Not extending the ceasefire agreement doesn't mean that we're going back to war. It might mean that there's a deal, and that's why the ceasefire agreement. Remember, the ceasefire agreement was only in place until a deal was reached. So what will probably happen is, so this official ceasefire deal won't get it. Say, for instance, let's try and game this out. Say, for instance, a deal is reached. This ceasefire deal expires, but then we just go into another ceasefire deal because a deal was reached.
The thing is, it's just going to be wordplay, right? And
exactly
I make you absolutely right. If it's not, if it's not an extension of a ceasefire, is it a truce?
Exactly.
Or do they agree to, a pause in hostilities while they negotiate a memorandum of understanding? Frankly, all of this is just diplomatic and legalese for there is not going to be any fighting. And I think that's kind of the assumption that most market participants are working on. Of course, we could be wrong. We hope we're not. We could be here Thursday morning and everything has flared up once again. Of course, we hope that doesn't happen. It's certainly not an outcome that markets are priced for, but it does very much feel as if, the direction of travel is still pointing towards a deal getting done. Trump was again saying yesterday that he thinks, I should say, that a deal with Iran will happen, quote, relatively quickly. And again, I would generally be viewing all of the sources reporting and everything we see through the lens of basically either side trying to get negotiating leverage ahead of these discussions that are going to happen a little bit later on in the week, presumably during tomorrow's session.
Well, and just for clarity, so where we stand at the moment is the US delegation have already arrived in Pakistan. That's according to Pakistani security lockdown in Islamabad and sources there. And the NYT, New York Times, were citing two Iranian officials that an Iranian delegation plans to travel to Islamabad today at some point. If you're listening to this later on, maybe there's already been headlines saying that will happen. Obviously, Tehran, last we heard from them, they were still publicly denying it. One thing to flag yesterday, China came out, I believe this is possibly the first time they actually came out publicly and vocally saying basically we want a deal to be reached. We know that behind the scenes that China have been pushing Iran to come to the table, etc., because obviously China have got a lot of get a lot of their energy from China. China get a lot of their energy from Iran, and it's obviously a lot cheaper due to like the loans and the agreements that China have with Iran. It means that they get this hooky oil, a bit on the sly, a bit cheaper. Now, obviously, China want that, and they miss that, and also high energy prices globally are no good for China. So to see them actually coming out and actually position themselves as like a, almost like Pakistan, but a mediator on the sidelines if needed, and also pushing Iran publicly, you can see how much pressure now behind Iran coming into this. But again, it is kind of futile just to be predicting what's going to happen when we don't even know if people are going to turn up. And anyone, we've got, we saw like last week, Muppets, the usual crew saying, oh, Strait of Hormuz crisis, it's over. Well, obviously it's not. And we've also seen Muppets saying, oh, this war is going to drag on for years. No one knows that. So, this try and stick to the facts and what we know. Yes, it's not as fun, but, I'd rather be kind of positioned in a manner where I'm actually kind of aligned with the facts as we see them than just kind of guessing.
Indeed, yes. So let's leave the Middle East there, I think, because there's actually not really that much else to mention, unless we want to go through all of the individual
No.
sources' stories, which I don't think are going to provide a lot of value. Let's do the UK next, actually,
Yes.
because there's two things I want to talk about here. The first is the jobs data that we had out of the UK this morning. And it's another example of what we talk about so often here, which is that, the headline metric is fine for a glance, but you really do need to dig into the details of whatever data it is that's being released in order to understand completely what's going on. And there's going to be a second example of that a little bit later on in the show. In any case, for the February UK jobs report, headline unemployment actually fell to 4.9% in the 3 months to February, its lowest level since last August, and down from the 5.2% that we saw in January. Now, of course, you look at that and you go, well, that's great news. Unemployment is falling. But there's two reasons why unemployment can fall. Either it's because more people are finding a job, i.e. more people are getting employed, or it's because people are leaving the labour force, i.e. giving up on trying to find work. And that is exactly what we see driving the fall in unemployment in February. It largely came as a result of economic inactivity having risen by 0.2% to 21%. So basically what's happening here in the UK is not that people are suddenly getting, there's not this surge in employment happening, quite the opposite. In fact, the labour market is struggling so much and job vacancies are at such a low level that people are just giving up on their search for a job entirely and becoming economically inactive. I was just going to say very quickly. So actually, it's not good news at all. It is the complete opposite of that.
Well, this is it. And this is why I think this kind of headline employment rate, it's not true. It's not indicative at all, but it does warp the opinions of Joe Public. I mean, like, how many people, I reckon I'd be shocked how many people don't even know what the inactivity, that the inactivity metric even exists, let alone what percentage it is. I think that should be like a headline number. So 21% of the potential workforce, not even in, like, not even.
It's about 8 or 9 million people.
Yeah. So this isn't people that are looking for a job. This is people that have no interest in getting a job or can't get a job or whatnot and just aren't even looking anymore. 21%, that's a huge number. Now
it's 1 in 5 people.
And that, to me, when you hear unemployment rate, that's what everyone thinks. Everyone thinks that, if you ask someone what does the unemployment rate mean and you gave them the definition of the 21%, they would think that unemployment rate should match that. There needs to be a lot of education goes on amongst this because, again,
and this is not only education in terms of the members of the public, it's education in terms of market participants as well.
And MPs.
Because I would love to know. If I was that interested, I could probably find the data from our internal flow stats. But I would love to know who was buying the pound on the back, or if anyone was buying the pound on the idea that unemployment had fallen and that was a good thing, because quite clearly it is not. Also, the other thing to bear in mind with this is that is February data. So it's before conflict in the Middle East even happened. And when you look at the more timely metrics, like the PAYE payroll stats, PAYE payrolls actually fell by 11,000 in March. Now, that's a relatively minor decline in the grand scheme of things, but it is a second straight monthly decline after a downwardly revised figure in February. Again, it just points to how businesses are being relatively cautious in terms of their hiring plans as a result of what we've seen in the Middle East.
Yeah, well, you say market participants don't know what these numbers mean, but I guarantee most MPs don't know the difference even. That's the problem.
Well, it's funny you mention that because our good friend Michael Houston has just asked me, I wonder how many MPs are doing victory laps on the unemployment rate.
Well, this is quite, I can't wait for Rachel Reeves to say something because I'm going to go in with the, that 21% number.
You know it's coming. But the other UK headlines, speaking of energy prices, this is just utterly fucking mental, to be completely honest with you. Here in the UK, we have a windfall tax on electricity generators, which is frankly ridiculous in the first place because it means that these companies are paying marginal tax rates of 70 or 80%. Well, what the government have decided to do in their infinite wisdom this morning is announce that this windfall tax is going to be increased from the current 45% to a new level of 55%. The government saying that these extra funds will be used for, and I quote from their press release, investment in renewables and support for those suffering with higher energy bills. Of course, in reality, what's going to happen here is that the government are even further reducing the incentive to invest in domestic energy infrastructure, because those who do so are just being penalised at every single possible opportunity that the government finds.
Quite. It was our good friend John Stepek, wasn't it? We will continue taxing until prices come down.
Yes, exactly that.
But the joke of this is, we know electricity prices are far higher than anywhere else in Europe, well, pretty much in the world at this point. And Ed Miliband just cannot understand that it's policies like this that are causing that.
Yep.
And also what I've seen as well is he's actually going to increase the tax on generation from wind farms and solar. So his kind of like golden goose that he's kind of saying is saving us, he's about to charge them more as well. I mean, at what point do we start calling him Agent Miliband and find out that he's some like spook from China or Russia or wherever trying to completely destroy the country?
Yeah, I mean, this is utterly nonsense.
That was a joke, by the way, before anyone thinks that.
Before the lawyers ring us up. Exactly. But it is utterly nonsense. I mean, if there is anyone out there who can tell us why this is a good idea or if there's even a logical case for it, I'd love to hear it, because I just cannot see one. And of course, the net result of all of this is that this will just further increase our reliance on energy imports. And of course, we're doing this at a time when we all know that energy is very, very scarce in the world at the moment, given what's going on in the Middle East, with the infrastructure damage, with the Strait of Hormuz remaining impassable. What we should be doing is actually trying to boost our domestic energy industry, boost investment in the sector, become more independent, become more self-reliant. And what the government are doing is the complete and utter polar opposite of that.
No, exactly that. Yeah, and again, as Ed Miliband said in an interview, I think it was this morning or yesterday, where he said, I'm not against drilling. I'm not always against drilling of natural gas and whatnot. I mean, he proved that because a gas field has just been given the green light to kind of start extracting gas. But it's okay because they're not extracting it to create electricity that could feed the grid. They're extracting it to power a Bitcoin mining farm. And Ed Miliband's fine with that. I honestly, at this point, the concern is now that he has no interest in listening to another side of the argument. He literally he's got his blinkers on. He is 100% convinced that he is correct. And the problem is when you get a policymaker with any real power that believes above all else that they are the ones that are correct and that everyone else is wrong, they become very dangerous, because then you start getting people like Ed Miliband that can't see the forest for the trees, makes horrendous decisions for the long, in the long term, and eventually when they do get booted out of their position, you can't really turn around the unfortunately it takes a while to turn around the policies they brought in, and the damaging legacy lingers on for the rest of us.
Yeah, the damage has been done. That's the problem. Of course, the other issue, and I shudder at the thought, is that Ed Miliband could become Chancellor or Prime Minister or some other great office of state, even when there is a Labour leadership challenge. And the other thing I would say is absolutely correct from Ian the dog, who seems to have developed the ability to type, saying less of these data centres going up. Absolutely. OpenAI have already paused their Stargate project here in the UK, saying that power costs are too high. And actually, our good friend Tom Talks Cars has mentioned this on numerous occasions, that the cost of electricity is simply prohibitive for any investment in the tech sector in this country. So not only are we shooting ourselves in the foot from a consumer's perspective, but from an investment one as well.
Yeah, exactly. And unfortunately, it's not just the electricity price as well. It's also the underlying regulation as well. It's just inhibitive to investment on a number of levels. But moving away from the UK, because although we are British and proud, well, most of the times we're proud.
This is less proud at the moment.
This is a global show. So going across the pond for a second before we look ahead to the rest of the day, although this is later on today. Walsh, what's he up to?
Indeed. So Kevin Walsh, obviously President Trump's nominee for Fed chair, is going to be having his nomination hearing in the Senate this afternoon. This kicks off at around about 3 o'clock this afternoon, London time, 10 o'clock this morning on the East Coast of the United States. Now, I've got a bit of a bone to pick with John Authors at Bloomberg on this one, because he put out a note this morning. His note is very, very good. And he said, and I quote here, "It doesn't matter what Kevin Walsh has to say today." Basically, his argument being we can ignore what Kevin Walsh says because the actual nomination itself is somewhat stalled due to Senator Tom Tillis withholding his vote until the DOJ investigation into Fed Chair Powell is concluded. Now, I would say that is a complete utter nonsensical take, because once the investigation wraps up, Senator Tillis is going to vote to proceed with Walsh's nomination, and it would be quite handy to know what the next Fed chair thinks rather than just blithely ignoring the fella.
Especially as he hasn't spoken for fucking ages.
Quite. The last time Kevin Walsh actually spoke in public, as far as I can work out, was July of last year when he gave a CNBC interview. And actually, that interview wasn't particularly instructive. I watched it back yesterday because I have no life. And Kevin Walsh was talking about how the Fed needs regime change. He was also talking about his strong belief in monetary policy independence, but he didn't really give any clues as to how he would operate when he's at the Fed. And actually, even if he had, they'd be out of date at this point, because that was 9 months ago and the world has moved on. I think the kind of key theme of Kevin Walsh's economic view at this moment in time is broadly in line with a lot of the other candidates for Fed chair, people like Rick Reeder and David Zervos, in that Kevin Walsh seems to believe that what we're going to see over the next kind of 3 to 4 years is what's broadly been described as an AI-driven productivity boom. Ooh. And if that were to happen, that would likely mean that we see a much faster pace of economic growth, but that faster pace of economic growth doesn't bring with it inflationary pressures. And as a result, it means that the Fed can adopt a looser monetary policy stance and likely lower the Fed funds rate, potentially to support the employment side of the dual mandate. Now, the reason why this is important is because a number of other FOMC members, who of course have a vote in where the monetary policy goes, have been asked about this theory and this thesis in recent weeks, and they all sound somewhat skeptical of it. Now, if Walsh wants to get rate cuts through, if he wants to adopt a more dovish approach, he has no choice but to bring those fellow policymakers with him. So I think it's going to be very, very interesting what Walsh has to say, because we need to look at that not only through the lens of this is how Kevin Walsh views the economy, but also through the lens of this is how Kevin Walsh might try to convince 11 of his colleagues to also view the economy the same way. Whether he actually takes up the post in mid-May, as we expect, or at some point later in the year, those arguments, those debates, those discussions are still going to take place. And I think it's very, very important to keep an eye on what he has to say.
No, exactly that. Yeah, I'm a bit surprised by John Authors there because, like I said, he's normally very much switched on. And to say just, you can ignore the comments today it's a puzzling one.
Yeah, and they may not be market moving today, and not every bit of news is, but they can't ignore them. Constructive moving forwards. Absolutely not. The other thing I would just say in terms of Kevin Walsh, and the other area that's going to be particularly interesting. Now, I say both of these with the caveat that he's being asked questions by senators, not by investors. And what that means is particularly the Democratic senators on the Senate Banking Committee, they're going to relentlessly ask him about his views on Trump, about his wealth, about his family wealth, any conflicts of interest, all of that kind of crap. Markets aren't going to be interested in that. That goes without saying. If we are lucky enough to get any questions on this, then I think it's also going to be worth watching, which is Walsh's views on the Fed balance sheet, because he has said previously, again last year, and I quote, that the balance sheet is trillions of dollars larger than it needs to be. So is Walsh looking to reduce that? If he is, how is he going to do so? Is it going to be regulatory changes? Is it going to be, a faster pace of balance sheet runoff? We don't know. That's something worth keeping in mind. It's also worth keeping in mind that actually the balance sheet isn't that much bigger than when Walsh left the Fed in 2011. Relative to the size of the economy, the balance sheet was at 17% of GDP when Walsh resigned from the Fed in 2011. Right now, according to the data I looked at 20 minutes ago, the balance sheet is at 20% of GDP, which to me is not a huge move, but to Walsh, it seems large.
Yeah, no, exactly that. Is there anything else going on today that we need to be aware of?
There is actually two things just worth bearing in mind. At 10 o'clock this morning, we get the latest ZEW sentiment surveys out of Germany.
I do love the ZEW.
Well, I'm not sure the Germans are going to love it because this is April data, and of course, it's going to reflect another 4 weeks of conflict in the Middle East. So the expectations metric is seen falling to -5.8, down from a prior -0.5. The other notable data release on the calendar today comes from the United States at 1:30 this afternoon, London time, and that is the March US retail sales report. Headline sales seen having risen by 1.4% on a month-on-month basis last month, up from a prior 0.6%, with the ex-autos measure seen rising by the same amount. Now, this is where I'm going to give the second sort of nerdy data nugget today. US retail sales measures the change in overall sales value, not the change in sales volume. Why is that important? Well, you think what happened last month. Energy prices went through the roof. Gasoline or petrol prices went through the roof. That means that people are going to have spent more because of higher energy costs. It's not a sign of some sort of, unexpected, surprising exuberance among US consumers. It's simply a quirk in how the data is calculated.
Buying less, paying more.
Exactly that. And that is why the control group sales metric, that's actually seen rising by just 0.2% on the month. That excludes autos, it excludes gasoline. It's basically the basket of goods that feeds into the GDP numbers. And that will be down from the 0.5% that we saw in February. So if we do see a strong headline retail sales print later, don't get carried away with it. It is just a quirk in the statistical calculation that goes into the data. It's not a sign that the US consumer is, all fine and dandy. You look at consumer sentiment, for goodness sake, it's at a record low. Yes, there's issues with that survey, but it just speaks to the idea that, it's a data issue, not a signal that we can take in terms of looking at the US consumer moving forward.
Exactly that. Well, Michael, thank you so much for today, as always, my dear friend. Listeners, we hope we put a bit of value into your day and a smile on your face, as per usual. Good luck today with whatever you're doing. Keep an eye on the headlines, as usual. Yeah, and we'll see